Digital currencies have been all the rage these days. Ever since the inception of Bitcoin in 2008, it's nearly impossible to come across anyone nowadays who doesn't have an opinion about the concept of digital money. Some believe digital currency is the future and the way to go. Others believe that digital money will lead to a mass implant of microchips and the mark of the beast. While the Wall Street bad boys, on the other hand, are simply trying to make a buck buying different cryptocurrencies low and selling high. Fairly complicated way to make a living as a crypto trader if you ask me, but some say it's a nice gig. While private cryptocurrencies such as Bitcoin and Ethereum may be grabbing headlines, central bank digital currencies could end up having a much greater impact on our future economic landscape, especially when you consider how many countries worldwide are working towards developing their own CBDCs. The global race to launch a central bank digital currency is heating up, and it's no longer a conspiracy theory. In today's video, we will discuss how government-issued digital currency differs from private digital currency like Bitcoin or Ethereum. As you would expect, anything that's government-made is rarely impressive. In the case of CBDC, things take even a darker turn. We will learn how central bank digital currency would have the potential to allow the issuer to oversee and control how you spend your money. Welcome back, guys. My name is Vitaly. As always, thank you for sticking around, and if you find this content interesting, please make sure to smash the like and subscribe button. I recently talked about how, despite the surrounding controversies about blockchain and crypto, over the years, this technology developed as a disruptor in many different industries. As more businesses adopt the concept of blockchain in their practice, central banks around the world are paying close attention too. The buzz around crypto is now too loud to ignore, and there's no way the government will miss out on the ride. The question is, why would any government obsessed with controlling the people suddenly become so interested in a technology designed to disarm them of that very same control? What do I mean, you might ask? Well, as you know, the essential nature of most cryptocurrencies today is to enable decentralized peer-to-peer transactions without the need for trusted third-party financial institutions. Under this setup, there would be no need for central bank or any central decision-making authority upon which our today's financial system is built. In other words, imagine you remove the venom glands from a venomous snake, and just like that, the snake is no longer venomous. Under a decentralized financial system, the central bank, masquerading as an economy stabilizer, will lose its venomous power of currency manipulation and wealth confiscation through inflation, and who needs that? This is exactly why, unlike Bitcoin, CBDCs are a different animal and quite the opposite of decentralized finance. The concept of digital money is not new. In fact, most of us rarely carry cash nowadays and pay for things with a swipe of a credit or debit card. In a recent article featured by Harvard Business Review, the author wrote, over 97% of the money in circulation today from checking deposits, dollars deposited online and converted into a string of digital code by a commercial bank. The digitization of credit and debit card transactions and the development of banking apps have moved many traditional cash-based transactions into digital space. You might ask, well, what's the difference between CBDC and a regular credit card or app-based payments that are already digital? Today, the only way for consumers to use money that's a direct liability of a central bank is with physical cash. Current digital retail tools use the same currency unit, in the case of the United States is the dollar, but they are based on money that is liability of the commercial bank providing the account, not the central bank. In an article titled Why Central Banks Got Serious About Digital Money, Carolyn Luke from Bloomberg writes that money provided by a central bank, like cash, is generally considered a risk-free asset. For example, a dollar bill issued by US Federal Reserve is always worth $1. A dollar in a commercial bank account, while in theory convertible into paper cash on demand, is subject to that bank's solvency and liquidity risk, meaning consumers might not always be able to access it and can lose money if the bank goes bust. Carolyn further writes that CBDCs like banknotes and coins would be a direct liability of the central bank, carrying its guarantees. To simplify, imagine every citizen has checking account with the central bank. Run on banks and insuring depositors would be a thing of the past. While CBDCs are still in early stages of research and development, the central bank's campaign for this technology is to revolutionize the 2 centuries-old traditional banking model and offer people a better and more secure way to transact. It will also provide a way to cut down on the inefficiencies of printing and moving physical cash. The campaign also claims that CBDCs promote financial inclusion. About 5% of the people in the United States are unbanked, and with this new technology, it will be easier to integrate people into the financial system. It really sounds like the central bank digital currency will fix many of the issues in the financial world. You almost want to say, what's the catch? As you would expect, there is a catch, and one obvious risk concerning CBDC is Privacy. Unlike with cash, where the government cannot trace it and no third party is needed to verify a transaction, that's not the case with the central bank digital currency. Augustine Carstens, the head of the Bank of International Settlements, in a video discussing CBDCs said, "We don't know who's using a $100 bill and we don't know who's using a 1,000 peso bill today. The key difference with the CBDC is the central bank will have absolute control and rules and regulations that will determine the use of the expressions of the central bank liability, and also we will have the technology to enforce that." A Telegraph article from June 2021 wrote that digital cash could be programmed to ensure it is only spent on essentials and goods that an employer or government deems sensible, claiming that there could be some socially beneficial outcomes from that, preventing activity which is seen to be socially harmful in some way. While the design of central bank digital currency may sound surprising and appears to be very invasive, it's no surprise that governments around the world have been obsessed with control, providing you security in exchange for your privacy. A few years ago, the development of CBDCs might have sounded like a conspiracy theory. Today, it's a reality. A new report from Bank of International Settlements estimates that up to 90% of national central banks are at least in a planning stages for launching a central bank digital currency. Bank of America says digital US dollar is inevitable and is expected to be issued between 2025 and 2030. China has been leading the pack among many other countries, including the United States, with its digital yuan currently being tested in several cities. That's all I have for you today, guys. Please feel free to leave a comment below and share your thoughts, and I will see you on the next one.